Let's get connected with Sorbh again. Sorbh, hi, afternoon. And so I was asking you about your understanding of the market right now.
Yeah, good afternoon, and thanks for inviting me. Equity markets do react to noises, and we have enough of noise on our plate right now because of tariffs. And not to trivialize the issue, definitely tariff and 50% tariff will have its impact on the economy. But whenever such noise gets created, equity markets generally react on a very homogeneous manner. But slowly and steadily, markets will understand what is the actual impact on fundamentals, on earnings of companies, and then I think there will be a clear pullback on the markets because direct impact on listed entities is very less of this tariff. What we saw a couple of days back was that hardly 2% of revenues of MSCI India gets impacted directly by tariff. So clearly, we don't see a lot of earnings downgrades happening because of this tariff issue, especially on the BSE 500 companies. But the noise is there, and definitely some myopic, if I can say, short-term investors, traders will feel jittery, and there could be a bout of selling. FPI selling, we are seeing that can continue. But this also throws up decent opportunities on companies which are not getting impacted, especially consumption-focused companies, where government is all trying its best to revive the consumption sentiment in India, in the country. So we are seeing opportunities over there. So these falls can be used to pick up those names which are not getting impacted, in fact, getting positively impacted by the government steps on reforms and reviving the consumption demand. So that's how we are looking at the markets right now.
Saurabh, hi, Ankur this side. You mentioned about the consumption themes. Now, which are the pockets one should focus here? Is it alone FMCG sector, auto, or you have some more suggestions?
Sure. So consumption, I think it's a very broad-based theme, and we have been positive sometime much before this GST thing came up, because we clearly see positives around the tax cuts which happened during the budget. Then the interest rate cuts also helps the consumption economy. That's the second positive that came up. Monsoons have been good, and then now this GST thing. So I think government is putting in all bazookas in place to revive the consumption. So consumption, we are very positive on consumer tech companies. I think those are companies which benefit and they have no impact on tariffs. So that's a pocket we are positive. Auto, again, positive. Valuation comfort is there. And if GST cut happens, it can have a good trigger for the stocks to move up and volume growth to come back. We're also positive on building materials and paints. We believe this sector has lagged in terms of demand, but with discretionary income improving because of government steps, I think this is one segment one should look at very closely. And there could be some upside over there, and consumer durables also offers some upside here. So these are some of the pockets that we believe can do well, besides definitely staples, which are already doing well right now.
Right, Saurabh, now since you are with us, a lot of investors are interested in investing in mid-cap and small-cap. So any beaten down valuations over there, which can be, an opportunity time for your portfolio?
Yes, definitely. We clearly see pockets of valuation comfort that have emerged over the last 3-6 months on the mid-caps and small-cap space. So one is clearly building material space and the late real estate cycle plays like plywood companies, like tile companies, like paint companies, where there is a valuation comfort and there are positive triggers lined up in terms of demand recovery. So that's one pocket that we like. We're also looking very carefully on the domestic pharma space, not necessarily consumption, but that's one space on the mid and small cap side where compared to historical valuations are comforting. And because US focused pharma companies are facing issues because of tariff or no tariff created noise, this is a very sweet spot pocket that has emerged with a steady 15-20% compounding you can get on the domestic pharma side. So that is one pocket investors should look at. One should also look at chemicals. While most of the chemical companies in India are exporting companies, but a lot of them also export to Europe, not only US. And a lot of anti-dumping duties are being placed on Chinese companies who are exporting to US and Europe. So I think there is a pocket of real good opportunity that is emerging in the chemical space. One should look at very closely. And a lot of chemical companies, if you see, have finished their capex in the last 3 years or about to finish their capex, have doubled their capacities. and the valuations are very comforting. At this point in time, whenever the demand comes back, the growth that these companies can offer vis-a-vis what valuations they are trading at, they offer very good upside.
Right, thank you so much, Saurabh, for joining with your views. With this, it's time.